Welcome to the 3 Edge Week in Review for the week of March 15th, 2021. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joined here once again today by Steve Cucchiaro, President and Chief Investment Officer of 3 Edge Asset Management. Today, along with a brief update on the global capital markets, Steve and I will be discussing the potential for the return of the Bond Vigilantes. But first, a very brief update on the global capital markets. After reaching new all-time highs earlier in the week, equities struggled, with U.S. equities closing down for the week, although both gold and Japanese equities finished the week in positive territory. This week, investors were laser-focused on the meeting of the Federal Reserve's policymaking board, the Federal Open Market Committee. And then on Wednesday afternoon, the Fed announced their intention to leave short-term interest rates unchanged and to continue to purchase $120 billion of bonds per month. Neither of these announcements were a surprise to investors. However, as is often the case with Fed announcements, the devil is in the details. So, for example, this week, 4 Fed members now indicate that they expect the Fed to need to begin to hike interest rates as soon as next year, which is up from 0 members expressing this opinion back in December of 2020. The Fed also upgraded their forecast for economic growth for 2021, their forecast for their go-to inflation indicator, the core PCE deflator, which is now projected to reach 2.2% in the fourth quarter of this year. In addition, the Fed revised their unemployment forecast down, meaning to the good, to 4.5% in 2021. In spite of these upward revisions to the Fed's projections for growth and inflation and declining unemployment, Fed Chair Powell continued to insist that he expects that any rise in inflation will turn out to be transient, and therefore there's no need for the Fed to even begin discussing the idea of raising short-term interest rates. So now let's move on to our topic for today, which is the potential for the return of the bond vigilantes. This week, interest rates on both the 10-year and the 30-year U.S. Treasury continued to move higher. 10-year U.S. Treasury yields now have climbed to 1.75%, which is the first time that they've reached that level since January of 2020. The 30-year reached a yield of 2.5%, first time since August of 2019. So investors are concerned that the Fed is perhaps too content about allowing inflation to accelerate. And before we get into whether this signals a return of the bond vigilantes, let's just review where that expression came from. The term was originally coined in the early 80s by well-known Wall Street economist Ed Yardeni, and what he said was that bond market participants at times were known to keep order and exact punishment in the bond market by selling their bonds or making their presence known during U.S. Treasury auctions by forcing up interest rates when they believed that central banks were running monetary policy too accommodatively, or governments were increasing fiscal deficits by too much. And then, of course, the concept of bond vigilantes was immortalized in the 1990s by President Clinton's political strategist James Carville, who's credited with the following quote. He said, "I used to think if there was reincarnation, I wanted to come back as the president or the Pope or as a baseball player with a 400 batting average. But now I just want to come back as the bond market because you can intimidate everybody." So let me bring Steve in and let's see. That quote, Steve, is obviously from the 1990s. We know that things are much different now, but it certainly does seem as though since the financial crisis, right, 08, 09, and then reinforced during this past year with the global pandemic, the Federal Reserve's extremely easy monetary policy has overwhelmed the bond vigilantes. Is that an accurate description?
I think that's a very accurate description, Fritz. I think the return of the bond vigilantes is a very big deal, and interest rates have climbed more sharply this year than going back decades. We haven't seen this happen in a long time. And like you ask, since the financial crisis of 2008, the bond vigilantes have completely disappeared from the face of the markets until very recently. And I think the reason is because the Fed had a big change in the way they carried out their policy. Ever since their founding in 1913, right up until the financial crisis, their scope was largely focused on controlling short-term interest rates and letting the market control long-term interest rates. And so if, for instance, as you mentioned earlier, the government is accused of overspending or threatening to overspend, the bond vigilantes would come in and say, oh, you hold off. If you start to overspend, we're going to demand a higher interest rate to lend more money to the US government and make bond yields go up. And then the government would back down. It would be an act of discipline. Well, in the financial crisis of 2008, the Fed came in with all guns blazing and said, not only are we going to keep the short-term rates artificially low, but as a rescue effort, we're going to keep the long-term rates artificially low as well. Right. And that overpowered the bond vigilantes. So they disappeared. And then after the financial crisis, certainly their hope was this would be a one-time event and then they go back to normal. Well, every time they try to go back to normal, the stock market would have a fit and would start to correct sharply until the Fed agreed to add more stimulus and hold the long-term yields down more. And so every time they try to normalize, the market would have a fit. They would relent. And this was going on for years until just recently. And now, while the Fed is still printing lots of money, they're focused again just on the short term, and they're letting the market control the long term. And the market's saying, no, we think that maybe the government's overspending again, and it's time to ask for higher yields. So that's why we see the yields going up.
Interesting. So currently, maybe we're seeing the early stages of the return of the bond vigilantes. One question that I would have then is, I know, of course, you can never know this, but what might indicate that this might be a short-term phenomenon, or what might be giving us clues that this could be really for real and could last longer, and we could see interest rates continue to rise higher?
Well, there's a tug of war going on between where the bond vigilantes think the long-term interest rate should be based on the growth of the economy, based on inflationary expectations, versus what the Fed is going to allow it to happen. Because while the Fed has stepped back from the long-term market, they could come back and intervene again, especially if the stock market had a big crash. So we'd like to share this graph. Shows the very strong relationship over time between where the 10-year Treasury bond yield usually sits relative to economic growth and inflation. And nominal GDP is the combination of the growth of the economy plus the inflation in that economy. Going back 150 years, the average US Treasury bond yield at the 10-year level is 4.5%. Going back over the same 150 years, the average US nominal GDP, which combines both real growth and inflation, is exactly 4.5%. That's not just an accident. That's really what the theory says it should be. If you look at the chart, we are now at the biggest gap below nominal GDP in the 10-year Treasury yield. And what it's saying is that the 10-year, which is at 1.7% right now, should keep gravitating higher until it reaches around the 4% level, just to get close to growth plus GDP. And what would stop that would be if we had another big market correction and the Fed said, well, we better intervene again.
Interesting. Okay, so here's the important question, I guess, that follows that, and that is, this question is, so what could investors do to protect themselves from these bond vigilantes?
So if you think about which investments benefited the most from these artificially low rates when the bond vigilantes disappeared, they are US bonds, certainly, because they do well when interest rates come down, and US tech and growth stocks, which benefit with very low interest rates because it justifies the higher valuations, anticipating the growth way off in the future, and the time value of money being so low, it discounts those future earning streams with a lower discount rate. So that's what benefits. And sure enough, in the last decade, the two places that have done the best have been the large cap tech and growth stocks in US bonds. So I would say now is not the time to invest with a rearview mirror. Now is a time where when the bond vigilantes come back and continue, those are the two areas that are most vulnerable. So rather than thinking about your stocks as what did well in the past without the bond vigilantes, think about what might do better with the bond vigilantes. And those would typically be value in international stocks. And then in terms of the bonds, think about fewer bonds and more real assets.
Great. Thanks, Steve. We will keep our eyes out for the Bond Vigilantes over the coming months. So that will do it for Steve and me. We'll be back next week with another edition of the 3 Edge Week in Review. All of our videos are available on our 3 Edge YouTube channel, as well as on our website at 3edgeam.com. You can subscribe to our 3 Edge YouTube channel as well, so that you'll be notified as we release additional videos in the future. In addition, if you'd like to submit any questions or make suggestions for future topics, we'd very much like to hear from you. Just write us an email at WeekInReview, all one word, WeekInReview at 3edgeam.com. So on behalf of everyone here at 3 Edge, we urge you to remain safe, to stay strong, and to keep the faith. And most importantly, thanks for listening.